Hey, everybody, this is Charles Dobbins, founder of the Multifamily Investing Academy and the Multifamily OS system. I am here with my next guest on my hot seat, Mr. Jason Baik. Jason, you started the Underwriting Lab, which is what's called a one-stop shop for multifamily analysis. You do 3 levels of training. You get a self-paced one. You've got you actually do real boot camps in how to underwrite deals and how to evaluate deals. Or you also can you'll take it on for somebody. If somebody wants you to do the underwriting for the deal, that's part of your game as well. So how did you come into this? What was your background and how did you come into multifamily, and why did you pick out this incredible niche of being able to underwrite deals?
Great question. So I used to be in corporate America, used to be a data scientist. And I knew when I wanted to get into multifamily that I had to leverage skill sets that I already had. I didn't want to necessarily start from ground zero. So being pretty data driven, my entire career, and even back in college, have a degree in economics. So I figured I would try to bargain my ability to analyze data pretty well and try to get in on deals. And so that's how I eventually found the right team. That's how I managed to collect about 375 units today, and it's what I love to do. So it's something that the education arm came out of a lot of people reaching out because they know I underwrite pretty well. And I used to do more of the one-on-one coaching where I would just hop on a Zoom with someone and try to teach them how to underwrite from scratch. But because I'm still an active operator, I'm still in multifamily investing. I'm under contract to buy a property even today.
Oh, good.
So I decided to develop that into some courses and boot camps so that I can scale that a little better.
Now, you got the economics degree from Boston College, right?
No, I went to Northwestern.
Oh, you couldn't get into Boston College. I see. I know it's a good school. Exactly. Yeah. All right, fine. You walk right into that one. You say on your website, if you're opening up Excel as your first step, you're wasting time. All right, so explain that statement to me.
A lot of misconceptions about underwriting, from my opinion, that are the same exact misconceptions that are in corporate America, where everyone thinks that analyzing data is mostly about crunching numbers or, taking a look at a spreadsheet or a model. But at the end of the day, in real estate specifically, you're forced to make pretty quick decisions. And if you're opening up a spreadsheet and spending hours just plugging numbers in, that's not going to get you to where you want to be, which is to eventually close on a property. And I've developed a process that came out of my own experiences and talking to a bunch of other underwriters, where you always have to start off with a big picture and work your way down to the actual asset itself. So I made the mistake even a few years ago where I would spend 8 to 10 hours underwriting a deal. I'd be super excited because the numbers looked fantastic, and then I Google the actual address, and I figure that it's in a D class area, it explains why the returns look so good. So making sure that you do a little bit of subjective anecdotal research, at least from the get-go, will make sure that your process is efficient and you're not just wasting a bunch of time looking at numbers only.
Yeah, when I did that, I remember one of the first times I Googled the address, and like this very recent murder that had taken place on the property popped right up. I thought, oh, geez, what a waste of time this is going to be. All right, so let's talk about, before you start looking at the numbers, before you get the spreadsheet at 30,000 foot view, what are the types of things you look at that are more subjective, and what sources on the internet do you use to give you that best information?
There's a lot of great free resources out there that, if you're starting out, you can leverage that don't necessarily have to be the big CoStar reports. Bureau of Labor Statistics has a ton of great data on macro market information. I love using.
Okay, let's get granular with that, because everybody throws out the BLS. But my question to you is, once you get there, what are you looking for? And this is what really distinguishes you guys. And when I say that, I mean data scientists, who I find fascinating how they think about things. You go to the BLS, and I go to the BLS, and we're looking at the data, but it means something different to you than it does to me. What is it that you see in the BLS data or that you're specifically looking for that's going to help you?
So let me take a step back then and also mention how a lot of people have a flawed methodology to look at the market itself. So a lot of people, they follow what a big institutional player does. They look at job growth and household income growth and
Right.
population growth. The problem with that, though, is that you don't make money as a small investor the same way that a big institutional investor makes money. You typically need a discount of some sort, right? You need to buy something for a little lower than you sell it for so that you make profit as a differential. A institutional owner, they can invest in Phoenix and Texas and Florida, hold on to a property for whoever knows how many years. They can outlast all market cycles. They can outlast any operational issues, and they can sell whenever it makes the most sense for them to make the profit. If you are using that same methodology to try and pick these market locations, you don't have the same advantages or the same leverage that a big institutional buyer has. So you shouldn't be using that as your way of trying to pick markets. And so high level, Bureau of Labor Statistics, I only look at job growth. There's a website called city-data.com, a great resource for household income growth and population growth. That is what you should objectively be doing. But if you take a look at every single major metro, right, and you compare them to all one another, and you want to pick the locations with the best household income and the best job and the best population growth, you'll end up with the same 10 places that everyone else is already in, right? It's Phoenix, Tampa, Dallas. There's no secret MSA that no one has tapped into yet. So when I talk to institutional people that hire me for underwriting, I use that same terminology, right? I use the BLS, I use citydata.com, I use datausa.io to do a lot of macro research because that's what they need. But if you are a mom and pop or you're just a small team that's starting out, you should be looking at an area where you have some sort of competitive advantage in. I don't know what that is. Maybe your uncle's a contractor in this town. Maybe your friend is a broker. Maybe it's a location that you grew up in and you just know really well. But that's how you break into real estate in multifamily, by finding a discount, not by following this generic rule of picking a market that really only applies to big players.
Interesting. That's really cool. All right. Let me ask you, what does it take to master multifamily underwriting?
That's a good question. I have a really different perspective just because data has been something that I've done my entire career. And so when people tell me that spreadsheets confuse them or they get scared by it, I can't really resonate with that just because I've loved numbers my entire life. Yeah. In my opinion, though, a lot of educational content out there today essentially just teaches you how to plug numbers into a spreadsheet, and plugging numbers into a cell doesn't teach you multifamily real estate investing. You can train a parrot to do that. You can outsource that to anyone. But if you really want to understand the nuances of how to invest in an asset, the best way is to get feedback from someone that has been doing this for a long time, because instead of understanding how to use a spreadsheet, which is really easy, you need to understand benchmarks. You need to understand real world implications. You need to understand how to account for different things that you just might not know because you haven't done this before. So being a part of a community, getting some tutoring, for the lack of a better word, is much more helpful in understanding how to underwrite than it is just taking, a Udemy course on how to plug numbers into a sheet.
Okay. Now you talk about benchmarks. Are your benchmarks, do you expect the new investor to start creating their own benchmarks? Should they be using, cheating off someone else's paper, or are there just industry standard benchmarks for our business that we all should know?
There are some loose industry benchmarks. I would say that most benchmarks are specific to a location because insurance and taxes can be wildly different. Labor and materials costs they vary widely depending on the location. So what I teach is typically a bare bones blueprint of what I see across most of the United States, just because I underwrite for clients and I underwrite for myself in most major metros. So I give a starting point, but it really is up to you to try and refine that over time. I wouldn't recommend a new investor try to create benchmarks on their own because you don't know what you're doing. So as a first step, copy off of someone to at least get a baseline, but understand that if you're looking in a specific area that's not particularly popular, you're going to have to talk to a lot of property managers. You're going to have to talk to contractors. You're going to have to talk to other investors to hone in on a little bit more of the accuracy.
All right. Now, what would you say is some of the biggest mistakes that new investors make in their underwriting?
That's also a great question. I think a lot of newer investors believe that they can buy assets with back of the napkin math. And I'm a big fan of simplified processes. But again, you're trying to copy a process that an experienced investor uses because they have experience, they've got connections, they've got, the background needed. If you think that you can buy an asset because 100 plus 20 is less than 150, then I think you have to go through more of the difficult effort of learning the nuances of this business. Because if it was that simple and you can use one formula that any fifth grader could use to buy a multi-million-dollar asset and succeed, then there'd be a lot more people who are successful. So underwriting is not easy, but it's also not particularly difficult. It's not rocket science. It's something that you can learn. You just have to respect it. You have to give it the time, and just you have to do you have to put in the hard work to at least understand the basics.
Okay, let's talk about different types of properties, like value adds versus rehabs versus performing assets. How do you underwrite those differently?
So it depends on a lot of factors. So I take on a lot of value add deals. I like injecting my own human capital into a property so that we can raise the value of it. So you have to, it's more so understanding the nuances of what that implies. So you can communicate it to your partners or to your lender or to, your investors. Value add deals typically don't have a lot of cash flow in the first year or two. Occupancy is typically a lot lower. And so you have to make sure that you are telling your bank that vacancy is going to be really high. So maybe you need some interest only years. Same with your investors. If you're taking on a big, heavy value add deal, you have to tell them, hey, don't expect cash flow or any distributions for 18 months, 24 months. On the other side, if you've got a stabilized deal, both of those won't really be problems, but you will also most likely have lower returns as well to passive investors. So the underwriting process is the same. There's nothing that really changes. Maybe you have to understand CapEx a bit for value add deals, right? You have to, because you're projecting a larger CapEx budget, you have to be a little bit more familiar with how much a parking lot costs or how much roofing costs or how much an HVAC costs. But the more important aspect of value add versus stabilized is actually the implication of returns to passive investors.
Okay, that's perfect. I'm glad you just said that, because one of the things that, people think that you and I are talking about is just determining whether this is a good deal or not. But then you need to take it to the next step, which is this going to be a good deal to our investors? And so your underwriting has to take that into consideration. To walk me through that process and also give me some ideas on different ways that you've structured deals.
Yeah, 100%. So it's important to note that you as a general partner and any limited partners are in the deal together. Both of your success feeds off one another, but your returns could be very, very different. So you have to walk this fine line of providing passive investors with enough to incentivize them to put into the deal, but you also can't cut too much from yourself. Otherwise, you're going to be doing a lot of free work for many, many years.
Yeah.
And so things like, purchase price, things like how much pref you offer, things like how much the GP and LP equity splits are drastically impact all of that. And I've seen underwriting from other teams where they'll do like a 95-5 split, or 95% of the deal goes to passive investors because that's what they needed to do to meet the minimum returns for it to be attractive.
Yeah.
And for stuff like that, my counter argument is there's opportunity cost. You're going to be spending 7 years joining property management calls, dealing with contractors, making sure that investors get their distributions and marketing updates. Is that all worth it for 5% of equity? I mean, for me personally, no, but that team obviously decided to pursue it. So yeah, there's a lot of.
That's a red flag to me also. Like, geez, guys, you're working for nothing. As soon as the market turns down and it looks like you're never making any money, who's going to run this property? You guys are going to walk.
Exactly. Exactly. You have to make sure that both the LP team have enough for them to be incentivized to invest, but also the GP team has enough to incentivize to work on this asset for the next few years. Because it's not a glamorous job being a general partner. It's a lot of hard work.
Yeah.
You have to make sure that the GP team makes enough so that they stay focused on your deal.
Yeah. There's another thing that drives me crazy is seeing preferred returns on repositioning properties or rehabs. It's like, guys, don't give me my 9% back. Get that property turned around as fast as you can. That's where the real money is, not in just paying me back. And a lot of times, if the property's not generating any income, but they're still paying me my 9%, where is that money coming from?
Exactly. A lot of people will buffer funds to try and make sure that the first 2 years are afloat, but
okay,
yeah.
I think you are being incredibly kind, calling it buffering funds. I call it Ponzi schemes, for crying out loud. It's my own money. You're just paying back to me.
Yeah, exactly. A lot of overraising is common in syndication.
Yeah. All right. Now, in your program, the underwritinglab.com, do you have your own software? Do you provide your own analyzer software?
Yeah. It's not that complex for someone like me to build a model.
Yeah.
I used to do much more complicated things back in the day, but I also
and even with all that said, you still couldn't get into Boston College. Okay, I understand.
I tried.
I bet you did. Yeah, sure you did. The Northwestern probably gave you a full ride.
If only they give they're a fancy private school, so not only scholarships given out.
Now wait, are you American? Are you originally from America?
Yeah. I mean, no, my parents are South Korean, but I was born in New York.
Okay, so you're just like everybody else. You got loans and stuff. It's those foreign kids that pay full retail for college.
Yeah.
Gosh, unbelievable.
That's why. Yeah, most foreign students are also from well-off families.
Exactly. Yeah, that's
true. That can afford it.
All right, so let's talk a moment about you. On your website, you talk about the 6 golden rules for maximizing efficiency. I'm not going to ask you to name all 6, but just explain what you mean with that statement.
So there's some back of the napkin rules of thumb that I like to use to make sure that a deal is worth pursuing, and that's part of what I teach. For example, making sure that your business plan fits the tenant demographic is incredibly important. I've seen times where people would say, oh, we're going to charge $1,500 in rent. We're going to charge RUBS. We're going to charge for smart tech packages. We're going to put stainless steel appliances in. And all of that is great, but you're in an area where the average household income is $60,000. So does that really make sense to be that aggressive, especially in today's environment? Maybe 2 years ago, real estate was kind of always going up. Tenants were doing well, but today, leasing is hard, inflation is high, so you got to make sure that you are matching the business plan to what you're looking to accomplish. And one of the rules is making sure that you take the average household income for the area, you divide that by 3 or 4, depending on how aggressive or conservative you want to be, and that number should be the max rent that you're looking to charge the average tenant, because that's the same rule that a property management company uses to actually vet your tenants. So you have to think like you are a property management company. You have to think like you're a tenant. You have to think like you're an operator, and make sure all of that kind of gels together in one cohesive business plan.
You talked a moment, about one of the biggest mistakes I made early on in my career. One of the first properties I ever purchased, I was on a street with 1,300 other units. Okay, there was this, I'm not butting up against everybody, and I'm brand new, but I know better than anybody else because I took a boot camp, and they taught me that one of the best ways to increase value is to RUBS your property. And these are all bills paid properties, man. All bills paid. Worst, I'm going to convert these to tenant paid properties. Well, do you know what happened, Jason? Overnight, everybody walked from my property across the street to the other 1,300 units that are all bills paid, because that clientele, that C-class tenant, they don't get utilities in their name. They don't pay extra for that. It comes all packaged together. And I didn't think this through and understand what my market was, and my whole thing failed.
Yeah, it makes. I see people all the time thinking, "Oh, let me just build a carport and I can charge $50 a month for a carport." And you look around, there's no carports around. Like the goal of multifamily investing is to ride the wave. You're not trying to be an innovator. You're not trying to be the first person to do something in a neighborhood. You just have to. You want to be comfortably middle. You don't want to be the worst asset, but you don't want to be the best asset.
Yeah.
Because the best assets are the ones that are taking the risk, trying to attract new tenant types.
Yeah. Very good. Very good. All right. Before I ask you a final question, tell us about the Underwriting Lab. What is that all about?
Yeah, it's my love of teaching others combined with my love of data. It's been something that I worked on pretty much all of last year. Spent a ton of time recording videos that are meant to teach people. It's not just webinars. It's not just stuff that I've done at events re-recorded. It's content where I talk to people and I teach them the nuances of underwriting as a business. And so it's a self-paced course. First and foremost, just 20 hours. It's a lot of hours of content, but I promise you, it's probably one of the most comprehensive courses out there. So that's sort of the main value that the Underwriting Lab provides. I do boot camps, or I used to do boot camps. I did about 4 last year. I don't know if I have the bandwidth necessarily to continue, but I created the video course kind of as a replacement for that anyway.
Yeah.
So I'm in the process of reimagining what the boot camps are, and then I charge an hourly rate to help people underwrite one-on-one. But I always say that it's not not cost effective for you to hire me for one-on-one sessions, because I'm going to charge you a lot. You might as well take the course first. And if you're a bigger team, maybe you just lost your underwriter. I've got people that just have a lot of deals and they already have a full-time underwriter that is overworked. I can kind of offload that burden as a consultant on my own. I don't take equity in deals. I just get charged an hourly rate. So that's sort of everything that the Underwriting Lab has to offer. But most importantly, it's trying to teach people the nuances of the business. I tell you benchmarks. I tell you the process. I tell you the real world implications of what all these pretend numbers mean. And I think a lot of content out there is focused, again, just on Excel. So I try to go a little bit deeper into that.
Okay. All right. Now, let me, you actually, what you said about switching from the boot camps to, deciding whether that's where you want to be, kind of reminds me of when I was first getting started. I did a weekend due diligence seminar. Okay. And it was me standing up there for, I think like 4 to 6 hours per day teaching underwriting, due diligence. And I'll tell you something, Jason, it was by the third boot camp, it was so boring to me. I was like, no, I don't want to do this ever again. So I just recorded it. I recorded the whole thing. And now, you can buy it separately. All of my students get it when they sign up with me. But man, I hope I never have to teach that class again. That's painful. So last question here. Give us one final tip that most people in this business, especially new people starting out, don't know about underwriting that they should know. Like, geez, I love the multifamily numbers. I love how when one number changes, it impacts 3 other things over here, and it's just beautiful. I call it a beautiful ballet of numbers. So, what would you say? Give everyone listening right now a tip that they have not thought of when they do the underwriting that you teach.
It's not necessarily a tip, but something that I am very transparent about with all of my students and even across my socials is that as a data professional, I can make literally any deal work. It's not that difficult to change some numbers. It's not difficult to increase rent a little bit, reduce expenses a little bit. And so my recommendation is always to understand at least a bare minimum of underwriting so you can vet someone else's deals or you can vet someone else's underwriting. You don't have to be the long-term underwriter that spends hours in spreadsheets. I get it. If you don't love what you do, you shouldn't really try to force yourself to love it. But in this world of real estate that's filled with a lot of marketing, it's really easy to make every single deal work. And when I mean every deal, I mean literally everything from a Class D asset in a Class D neighborhood to a Class A asset in a Class A neighborhood. I can make everything work.
Yeah.
Even if I'm not trying to be malicious, at the end of the day, my risk profile, my risk tolerance is just different from yours. And so you have to understand enough about underwriting so that you can make sure that this is the right investment for you. Just because I'm not actively saying that I made rent a little higher or expenses a little higher, again, doesn't mean I'm trying to be an asshole. It just means that maybe I'm a little bit more aggressive than you are. Maybe I'm a little bit more conservative than you are. But in order to reduce the miscommunication, you just have to know enough about underwriting so that you can look at deals yourself.
Yeah. Yeah. Very interesting. Cool. Hey, everybody. His name is Jason Baik, Baik. That's the Korean spelling for bake. Okay. Just everybody remember that. And the name of his website is www.theunderwritinglab.com. Check it out. I'm going to. Jason, it's so great to have you on today.
Yeah, thanks for having me, Charles. It's been a fun convo.
Yeah, and I guess, all right, Northwestern's gain is BC's loss. Okay, we'll leave it at that. So where are you from originally? Right in the Chicago area, or?
No, I grew up in Jersey actually. So grew up in Jersey my entire life. Wanted to explore somewhere that wasn't right by home. So yeah, went to Illinois.
You don't want to go to Rutgers?
No. Figured I could do a little better. I mean, I joke because my wife went to Rutgers, so I can't say shit talks too much.
Exactly.
Yeah.
So where do you live now?
I came back to Jersey. I mean, my parents are here. My wife's from Jersey. My wife's parents are here. My friends are here, so I can't really end up anywhere else.
Jersey boy. You're a Jersey boy. Yeah.
Jason,
great to have you, man. Good luck to you, and we'll talk soon.
Yeah, I appreciate it. Thanks, Charles.
Bye-bye.